directors, that has to be either below, as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this shillings 800,000 will be cancelled. In other terms, it will be written off, whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1,200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debit it with the total amount, because the full amount will be written off. Will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? Yes. So the question is, 𝐍𝐻 Limited, a company operating in mineral water bottling industry, is in financial difficulty due to unfavorable economic condition. The company statement of financial position as at 31st of October 2021 was as given below. So we are given the statement of financial position of this company as at 31st of October 2021. So we have non-current asset, which comprises of land, buildings, machinery, intangible assets. We have current asset, which comprises of inventory, receivables, cash, total asset. We have equity, which comprises of equity shares, 10% preference shares, 12% debentures, interest payable on debentures, loan from directors, accumulated losses. We have the current liabilities, which include bank overdraft, salary payables, and the total capital and liabilities. Then we have some additional information, number 1 all the way to note number 10. So we are required to make the journal entries to record the scheme of internal reconstruction. Number 2, to make to prepare the statement of financial position at 1st November 2021, immediately after reconstruction, and basically million ordinary shares of shillings 10 each, and 1 million 10% preference shares of shillings 10 each. It was decided during the meeting of shareholders and directors of the company to carry out a scheme of internal reconstruction with effect from 1st November 2021 as follows. Number 1, you're told, yes, I think we are recording our session. So number 1, you're told the assets are to be adjusted to their fair value as follows. So the assets now will be revalued to those particular good, to those particular values. So trade receivables 36, inventory 64, machine 2,000, buildings 5,000, and then we are given the accumulated depreciation to be charged. So that accumulated depreciation basically which you're given there, basically we need to ignore that, because generally what we know is that you cannot revalue an asset and you depreciate it at the same time. You revalue an asset and then you depreciate it at the end of what? At the end of there. So that was just to confuse you. So we will just work with those particular what? Fair values. So what we need to do is we compare those particular values given in note 1 with the values we have in the statement of financial position of the carrying amount. We determine whether you have a revaluation or actually an increase or a decrease in the value of the asset. We start with the receivables. Receivables in the statement of financial position, its value is 72, but receivables will be revalued to 36. So meaning that for receivables, the value for receivables will reduce from 72 to 36. So we have a decrease of 36. From 72 to 36, that is a decrease of 36. The other asset is basically inventory, which is still part of the current asset. Its carrying amount is 4,000, but it will be revalued. It will be revalued. It will be revalued to an amount of how much? It will be revalued to an amount of what? To an amount of 64. Okay, sorry. I think we are interchanging. So the value for receivables is 4,000. It will be revalued to 36. So means that we have a decrease of 400, a decrease of 400. So then we have inventory. Inventory will be revalued to 64. The carrying amount for inventory in the balance sheet is 72. So we have a decrease of what? A decrease of 800. A decrease of 800. A decrease of 800 from 72 to 64. Yes. So then from there we have machine. Machine, its carrying amount is how much? The carrying amount for machine is 28. It will be revalued to 2,000. So we have a decrease of 800. We have a decrease of 800. And then buildings, it will be revalued to 5,000. From 6,000, we equally have a decrease of what? Of 1,000. A decrease of what? Of 1,000. Sasa, yes, in that case, I've said both depreciations which are given there, we ignore them. I've said you cannot revalue an asset today and you depreciate the asset at the same time. So you revalue, then depreciate the asset at the end of the year. So therefore, we ignore those depreciations. So basically, it means that the value for all those assets, receivables, inventory, machine, building, their value reduces. How do we account for that decrease in the value of the asset? We said once the assets have been revalued and their value reduces, we need to credit the specific assets account in order to reduce its value. We complete the double entry by debiting the account called the capital reduction account. So therefore, the first general entry here is basically to account for the revaluation of those assets. To account for the revaluation of those assets. So if you check those values, they are basically in thousands of shillings. Okay, so when making the general entry, let's have the debit column here and basically the credit column. So we always start with the account to be debited. That's basically what we know. The account to be debited is the capital reduction account. And this account will be debited with the total decrease, or actually with the decrease, the total decrease in value for all the assets. We have 400, 800, 800, and 1,000. That will give us a total decrease of how much? That should be 12, 2,000, 3,000. Are you getting a total decrease in the value of assets to be 3,000? To be 3,000. We try to hurry because of time, yes. So then we debit that account, capital reduction account, and then we credit a number of assets. Which account are we crediting? First of all, we credit the receivables account. The receivables account is an amount of 400. We also credit the inventory account. The inventories account is an amount of 800. We credit the machinery account with an amount of 800. We also credit the buildings account. The buildings account is an amount of what? With an amount of 1,000. With an amount of what? Of 1,000. And then in this case, we said, make sure you give a brief narration. The narration will be being a revaluation of assets. Being a revaluation of who? Of assets. Being a revaluation of assets. So we have accounted for the revaluation of assets. Let's move to note number 2. In note number 2, we are told its ordinary share is to be redesignated as a share of 2.5. And then you're told the ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares held at a price of 4. Now, 2 things there. Number 1, we need to account for the decrease in the value of the asset, because we are told the shareholders will accept a decrease in the value of the share from 10 shillings all the way to 2.5. In this case, what we need to account for here is the amount of share capital, which automatically was written off. So the amount of share capital written off, first of all, we determine the amount which was written off per share. If the company is reducing the par value of the share from 10 to 2.5, it basically means that part of the par value has been written off. The amount written off is that decrease. So the value of the share is reducing with how much? Is reducing from 10 to 2.5. The value of the share, therefore, is reducing with 7.5. We multiply that with the shares issued by this company. And in this case, I hope you can see that information deals, note number 2 deals with the ordinary shares. So we go back to the balance sheet of this company, specifically at the equity. That's where we get the shares issued. So how many shares were issued by this company? We take the equity share capital or the ordinary share capital, which is 20,000. Remember, these are not shares. This is the share capital. How do we get the number of shares? we divide that with the par value, which is still in the balance sheet at the equity. I hope you can see the word equity shares of shillings 10 par value. So therefore, the shares issued by this company are 2,000. We multiply that with 7.5. And that basically will give us what? That will give us what? Will that give us 15,000? 15,000, the amount of share capital which is written off. The amount of share capital which is written off. Yes. So how do we account for that? How do we account for this? Remember, we say, in case we want to reduce the share capital, remember share capital has a credit balance. So if we want to reduce this, we debit that account. We debit share capital. We complete the double entry using the capital reduction account. So therefore, in this case, we will debit the equity share capital account. Equity share capital account with the amount which was written off, 15,000. And then we complete the double entry by crediting the capital reduction account with the same amount of 15,000. The same amount of 15,000. What is our narration here? Our narration is being the share capital, which is written off. So what we have accounted for here is the share capital which is written off, being the share capital written off, being the share capital written off. So in the same point, number two, we are told, other than the company writing off the value of each share, we are told that existing shareholders of the company will subscribe. To subscribe is to buy. If you buy shares of the company, you pay for those shares. So in this case, we are told they have to subscribe. They have to buy a new or basically new shares on the basis of one share. So these are the new shares to be issued. New shares to be issued. And basically I've said that these are shares to be issued in cash. The existing shareholders will buy some shares. So they are to subscribe new shares on the basis of one share, on the basis of one share for every what? For every 2 shares which are held, for every 2 shares which are held. Now, how many ordinary shares are currently held from what you have done up here? How many shares are currently held by the existing shareholders? The shares currently held, yes, we have said are 2,000. So these are the shares which are currently held. So we just cross multiply, then we divide, so that we determine how many shares are currently held. Sorry, how many shares will be issued, not held. So the shares to be issued will be 1 times 2,000 divided by 2, and basically this will give us 1,000 shares. 1,000 shares, and then we are told each share will be issued at 4 bob. Each share will be issued at an amount of 4 shillings. So meaning that the amount of money the company received here would be 4,000. Would be 4,000. So how do we account for this particular amount received by the company? How do we account for that amount received? Number one, because this money was received, the shareholders paid for that money, we debit the bank account. Remember this money received, we debit bank, and then the company issued shares. So we credit the equity share capital account. Remember, the amount credited to be credited in this account always has to be based on the par value. Now, what is the new par value per share? What is the new par value per share here? What is the new par value per share? The new par value per share, Ningapi. The new par value per share is 2.5. Remember, it was previously 10. It has been reduced to 2.5. So therefore, the amount to be credited in this account will be based on the par value 2.5 times the shares issued. The shares issued were 1,000. So the amount credited in this account is 225, 2.5. Now, it automatically means that because the shares were issued at 4 bob, the shares were issued at a premium, at a share premium. We said whenever we are accounting for external reconstruction and shares have been issued at a share premium, that share premium is not taken to the share premium account, but rather we credit it in the capital reduction account. Sasa, yes, that amount we will not credit it in the share premium account, but basically we credit it in which account? The capital reduction account. And automatically that should be the difference here. That should be the difference 15. So we give a brief narration being issue of additional shares, or maybe being issue of shares for cash. So we are done with that. Let's move to point number 3. We are told the existing preference shareholders are to be exchanged for a new issue of 6 million, 15% preference shares of shillings 10 each and 800,000 ordinary shares of shillings 2.5. So it basically means that if we go back to the balance sheet of this company, specifically at the equity, you'll see this company had issued 12%, not 12%, rather 10% preference shares. So the preference shares issued by this company, they have a value of 8,000. So we are told the holders of these particular shares will be required to surrender them back to the company, in exchange of what? In exchange of what? In exchange of 6 million. In exchange of 6 million, 6 million preference shares, having a value of 10, and 800,000 ordinary shares, 800 ordinary shares, each share having a value of 2.5. 2.5. Yes, and I think usually this question, there is a small typo, a small typing error. So this particular amount here, you see this amount here, 6 million, that's 6 million, that should be shillings. Because you can see that these preference shares currently issued by the company, they have a value of 8 million. So automatically, once they are required to surrender them back to the company, they are required to surrender these shares back to the company, they must be issued with other shares or even debentures having the same value. Having the same value. So if you take 6 million times 10, because you can see, take into account we don't have the word shillings before 6 million. We can only take 6 million to be the shares. So you should take the share 6 million times 10. That will give us 60 million. You can see that one is more than that. So that's why I'm saying there was a small typing error. This one should be shillings. If you have the physical paper, so before the word 6 million, we should have 6 million. The issue of 6 million, 15% preference shares of shillings 10, and 800,000, 2.5, or ordinary shares of 2.5, such that if you work out this now, you work out this 6 million, and then these ordinary shares which were issued 800 times 2.5. So if you multiply these two, this will give us what? Is it 2,000? 800,000 times 2.5. Is it 2,000? Yes, it should be 2,000. Such that if you add this and that should give us 8,000. So these preference shares which were issued and these ordinary shares which were issued, they must be having the same value, because the old shares, the old preference shares which have been issued are to be exchanged with the new shares. Yes, so that's why I've said there was a small typing error as far as that question is concerned. Now, what we need to do here is, number one, we cancel these shares. We cancel these shares. How do we cancel them? We cancel them. Remember, this account has a credit balance. So to cancel this, we will debit this account, and then we go ahead and basically debit to account. We debit this account for the new preference shares which were issued, and also we credit. That is to credit that account, and also we credit ordinary share capital. So we debit the 10% preference share capital, and then we credit to account. So we are canceling the old shares and accounting for the new shares which were issued. So we debit the 10% preference share capital account with an amount of 8 million, or basically 8,000, and then we credit these preference shares which were issued. They were 15%. We credit 15% preference shares, preference share capital account with the 6 million, and then we credit equity share capital with an amount of 2,000. Yes. So what is the narration? Being the old preference shares which were cancelled. Yes, and I think we are done with that particular point. Let's move to point number 4. In point number 4, what are we told? We are told that the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 each in lieu of interest payable. Then you're told the 12% debentures are to be converted to 14% debentures. And then you're told a further shillings 2 million or 14% debentures of shillings 10 each are to be issued and taken up by the existing debenture holders at 90 shillings per debenture. So in that case, I think we have like 3 transactions we need to account for. Number one, let's account for what we have in the first sentence. We are told the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. It basically means that the interest which was supposed to be paid to the debenture holders and was in arrears. So instead of the debenture holders being paid, that interest which was in arrears, they will accept. They will, instead of being paid that interest in cash, they will be issued with the ordinary share of the company as a form of a payment. So first of all, we need to determine how much was this interest or how much was the interest in arrears. That one is in the balance sheet of the company below paragraph 1 and specifically under equity. Can you be able to see the interest payable on debentures or the interest payable to the debenture holders at the equity? At the equity, yeah, that one should be 720, not 2000. Should be 720. So basically, what we need to do, remember that is a liability. So being a liability, we are told this amount automatically will be paid. How will it be paid? It will be paid by the company issuing shares. So we need to first of all cross off this account. Because the liability has a credit balance, how do we cross that account? We debit that account. So the journal entry number 5 is to debit that account. We debit the account called interest payable on debentures with an amount of how much? 720. And then the debenture holders here will be paid by being issued with the shares. So how many shares will be issued to the debenture holders? The debenture holders, in that case, we are told as per note number 4, they will be issued with 200,000 ordinary shares over 2.5. Or 2.5. Automatically, if you multiply these two, that one will give us 500,000. 500,000. So what happens, or what is the difference now here? You can see the amount which was to be paid 720, but the shares issued, they had a par value of 500. What happens to the difference? And remember, the amount to be debited has to be equal to the amount to be credited. Yes, the difference is the share premium. Do we take it to the share premium account? No. So we have said any share premium, any shares which are issued at a premium, any share premium is taken to the capital reduction account. So the difference here, which is 220, is the share premium. But do we credit it in the share premium account? No. We credit it in the account called the capital reduction account. Capital reduction account. So we can say in the narration, being payment of accrued interest. Being payment of accrued interest. So still in the same point, we are basically done with that. Still in the same point, sentence 2, we are told that the 12% debentures are to be converted to 14% debentures, just like what we have done here. So what we need to do is we need to cross off the 12% debentures account. If we go back to the balance sheet of the company here and the equity, you'll be able to see that our company had issued 12% debentures. 12% debentures. We are given their value. We know debentures is a liability. So this account should have a credit balance. So these debentures are to be exchanged, to be converted, that is, to 14% debentures. What does that mean? It basically means that we need to cross off that account by debiting it, and then we open another account called 14% debentures. So this account, we credit it with the same amount. So we debit the 12% debentures basically to cross off that account, and then we credit the 14% debentures account. So what is the value of these 12% debentures from the balance sheet of our company? The 12% debentures, they had a value of 6,000. So in other terms, we have converted the 12% debentures into 14% debentures. So narration, being conversion of 12% debentures into 14% debentures. Being conversion of debentures, or you can just put it like that. Remember that narration has no mark, but it's always good to give a narration of what you have accounted for. Sasa, yes. In the same point, we also have other debentures which were issued in cash. In the last sentence, a further shillings 2 million 14% debentures of shillings 100 are to be issued and taken up by the existing debenture holders at 90 bob. So these are new debentures to be issued. The 14% debentures, we are told having a value of 2 million, having a value of 2 million, but in this case we are told their par value is 100, but basically they will be issued at a discount. They will be issued at a discount because we are told they will be issued at 90 bob. So basically what that means is that our company here, instead of receiving 2 million, the cash to be received, the cash received will be what? Will be 90 all over 100 times what? Times 2 million. In other terms, because they have a value of 100, but they will be issued at 90, it's like they were issued at a discount of 10%. Sasa? Yes. So the amount to be received should be equal to what? Should be equal to 90%. Because they were issued at a discount of 10, the company received 90% of 2 million, which is 1.8. 1.8. So that is basically the amount to be received. How do we account for this amount received? The amount received, number one, this one will be debited in the bank account. We debit the bank 18 with the cash which was received. With the cash which was received. Now, the difference which is, or actually the discount which is 200,000, which is the discount, that one, basically we take it to which account? We take it to the capital reduction account. We must account for that discount. So that discount is 200,000. We take it to the capital reduction account because by the end of the day, the amount to be credited in this account, the amount to be credited in the 14% debentures, 14% debentures, just like what you have said in relation to the shares, that one has to be based on the par value. Remember, the par value is 100. So the amount to be credited in this account has to be based on the par value of 100. So meaning that the amount to be credited in this account should be 2,000. It has to be based on the par value, just like the shares, just like the shares. So the narration being an issue of debentures for what? For cash. Being issue of debentures for cash. We are basically done with that. So let's move to the other point, number 5. In note number 5, we are told shillings 800,000 of the loan from directors is cancelled, and then you're told the balance of the loan is to be settled by the issue of 200,000 shares of shillings 2.5. So first of all, can we go back to the balance sheet of this company? We check how much was the loan from the directors. The loan from directors, that has to be either below as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this shillings 800,000 will be cancelled. In other terms, it will be written off, whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1,200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debit it with the total amount, because the full amount will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? And that amount which was written off will be credited in the account called the capital reduction. This is the amount which was written off, the loan which was written off. It will basically be debited here, credited in which account? Capital reduction. Then this amount which was paid through the issue of shares, I hope you can see the number of shares which were to be issued to the directors. The directors were to be issued with how many shares? Are we given the number of shares which were to be issued to the directors? Yes, the directors were to be issued with 200,000 shares, 200,000 shares, each share having a value of 2.5. So if you multiply these two, 200 times that basically will give us 500. But you can see the amount which was to be paid by the company through the issue of shares, Ningapi, the amount which was to be paid through the issue of shares was 1,200. It also means that these particular shares which were issued to the directors were issued at a premium. Is that the position? Are they issued at a premium? Yes, because you can see the amount which was to be paid was 12, but the par value of those shares is 500. So therefore, what will be the double entry for that? We will credit the equity share capital with the shares which were issued, which are 200 times 2.5. 2.5, basically that will give us 500. So the difference between 500 and 12 will be a share premium. Where do we take the share premium? To the capital reduction account. To the capital reduction account. Remember, that is the share premium. That is the sharehood, the share premium on the shares which were issued. So by the end of the day, if you add this, the amount to be credited, the amount to be what? The amount which has been debited, you'll be able to see the amount is the same. So 800 plus the 500, which is 13, plus 700, 2,000, which is equal to that. So this is our narration being director's loan, which was cancelled, director's loan cancelled and paid. So we have accounted for the director's loan which was cancelled and the one which was paid. We are basically done with that. So then let's move to the other point, number 6, and I hope you're together up to that point. I hope you're together up to that point. Are we together up to that point? Can we move to point number 6? Yes, we are together up to that point. So in point number 6, you're told the investment are to be sold at their current market value of 6 million. So which are these particular investment? Investment automatically should be an asset. So if we go back to the balance sheet of this company, below the non-current assets, I can see we have intangible assets. One of the intangible assets is investment. The value for investment is 45. So we are told that investment, as per note number 6, we are told that investment will be sold at the current market value of 6 million. So the investment will be sold at a profit, because if you take the carrying amount of that investment is 45, but the investment will be sold at 6,000. So that profit, that gain on the sale of investment, that one automatically we cross it off, we take it to the capital reduction account. So first of all, we account for the amount which was received. The amount received, that one is debited in the bank. So how much amount was received? It should be equal to the sales proceeds. Sales proceeds is what we have in note number 6. Our investment was sold at 6 million. That is what we debit in the bank. That is what we debit in the bank. And then the amount which we credit in the investment account should be equal to the carrying amount. Investment was recorded at 4.5. We credit that account with 4.5. The difference, which is basically 15, we are saying is the gain on the sale of investment. So that gain on sale of investment, where do we take it? We take it to the capital reduction account. To the capital reduction account. So the narration here is being what? Being investment sold. Being investment which was sold. Being investment which was sold. Being investment which was sold. We are basically done with that. Let's move to point number 7. You're told bank overdraft was paid in full. Also very simple. Bank overdraft, we know, is a liability. Is a liability. So if bank overdraft was paid and is a liability, we need to cross off this account by debiting that. We debit that account, we credit bank account. So we debit bank overdraft account. Bank overdraft, this one has to be part of the current liabilities in our balance sheet. And the bank overdraft is basically 3,000. And then we credit bank account with an amount of 3,000. So the narration here is being payment of bank OD. 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 Yes. So we are done with that point. Let's move to point number and we are told the sum of 3.18 million is to be paid off, to offset the salary payables immediately, and the balance in 4 equal installments at the end of each quarter. So I think in our case here, what we need to do is to account for the amount of payables which was paid, or the amount of salary payables which was paid. So that one is basically quite simple, because what you just need to do is to, once a liability has been paid, we debit the liability account. So we will debit the payables account, or actually the salary payables, which is basically part of the current liabilities. Salary payables with the amount which was paid as per note number 8, that 180, and then automatically we do what? We credit bank. I hope you can be able to see down there. That 180. That 180. Then we need to give a brief narration for that. We need to give a brief narration for that. A brief narration for that. So being payment, or being partial payment, to who? To creditors. Being partial payment to creditors. Yes. So we are done with that, basically. And then we are told the balance will be paid in 4 equal installments. Are we interested with the amount to be paid in the remaining amount to be paid? No, because if you check on what you're told in part B, we are required to prepare the balance sheet of this company immediately after effecting this. So not even after a quarter, not even after a day, immediately after the company effected this. So we are not interested with the amount to be paid in those quarters. Yes, we are not interested with that. Then number 9, we are told all intangible assets are to be eliminated. Being eliminated means that all the intangible assets will be written off. Will be written what? Will be written off. So I need to create some space here. Yes, so all the intangible assets will be written off. Which are those intangible assets? Automatically, it is all the intangible assets excluding investment. Remember, investment was sold. So we need to write off goodwill and patent and trademark. So how do we write off assets? So basically, we credit the asset account, because assets have a debit balance. We credit the asset account. We debit the capital reduction. We debit the capital what? The capital reduction. So this should be journal entry number 12. We debit capital reduction account. Capital reduction account with the total value for the 2 assets. Goodwill 6,000, patent and trademark 500. That will give us a total of 65. And then which account do we credit? We credit goodwill with an amount of 6,000. We credit patents and trademarks with an amount of what? With an amount of 500. Narration being intangible assets which were written off, or maybe which were eliminated. Being intangible assets which were written off, or being intangible assets which were eliminated. Yes. So we are done with that. Then note number 10, we are told it is estimated that under the new arrangement, yes, now that information which we have in note number 10, that one will be used in answering part C. Do we use that in making the journal entries? No. That one will be used in answering part C of the question. So we are basically done, but there is something here we must always remember to account for, even if that information is not provided by the examiner. Remember, this company is trying to clean its books of accounts. Whenever the company is doing internal reconstruction, the company has to write off any accumulated losses. Even if that information is not given to you by the examiner, you must remember to account for that. You must write off the accumulated losses. So if you go back to the balance sheet of our company, specifically at the equity, you'll be able to see that the company had accumulated losses of 5.8. That accumulated losses has to be written off, because the company cannot do internal restructuring and still the books of account remain with accumulated losses. That has to be written off. So how do we write off these accumulated losses? So remember, this account always has a debit balance. It is the retained earnings account which has a debit balance, because those are losses. How do we write off that account? We credit it, and then we debit the capital we debit the capital reduction. We debit capital reduction account with accumulated losses of 58, and then we do what? We credit. We basically credit the accumulated losses account. Accumulated losses account with the 58. So what is the narration here? Narration is being accumulated losses, which were written off, being accumulated losses which were written off. And I think in our case, basically we have done with preparing what was required. So in part A, that basically what was required. So by doing this, the marks are allocated here are basically what? Are basically 10. In most of the cases, you'll see that the marks allocated here is half for every correct entry, half. So it basically means that you needed like 10 items, not 10 other, 20 items, 20 correct entries here. And basically you get the 10 allocated what? 10 allocated marks. Now, if you can be able to recall the other question which we did in class, after this, the examiner basically was requiring us to prepare the capital reduction account. Even though it is not a requirement in this question, can we prepare the capital reduction account? Let's prepare the capital reduction account, even though it is not a requirement here. Even though it is not what? A requirement. So let's prepare that account. I want to create some space here. So, but basically we have to remember here, our capital reduction will be debited with a total of 3,000. Yes. So let me create some space here. So we prepare the capital reduction account. Capital reduction. Capital reduction account, capital reduction account. Yes. So, and our figures are in thousands of shillings. Are in thousands of shillings like that. Yes. So we have said as per the first journal entry, basically we said you need to go through all your journal entries, journal entry number 1 up to journal entry number 13 as you check what is affecting the capital reduction. Journal entry number 1, our capital reduction account is to be debited. With various items. So the first entry comes from the account called the trade receivables with an amount of 400. The other entry is in the inventories account with an amount of 800. The other entry is in machinery account with an amount of 800. And basically the other entry is in buildings account with an amount of how much? With an amount of 1,000. So that those particular amounts are basically what? Are debited in this account and then credited in the respective account. In the respective what? In the respective account. In the respective what? Account. Then we go to the journal entry number 2. We check whether the capital reduction account is affected. Yes, capital reduction account, you can see, it's supposed to be credited. The other entry, so this account we credit this. So the other entry is in equity share capital account with this particular amount, 15,000. Journal entry number 3 is the capital reduction account affected. Yes, capital reduction account is to be credited with 15. So the other entry is in bank. That also affects capital reduction. Does this affect the capital reduction? No. Journal entry number 5 is the capital reduction being affected? Yes, capital reduction account is to be credited. The debit entry is in the interest payable on debentures, which is 220. So then this journal entry capital reduction is not affected. Here capital reduction is to be debited. The other entry is this account is to be debited. The other entry is in 14% debentures with an amount of 200. I can do away with this basically. Yes, so then from there we have the other journal entry here. This one. So the capital reduction account will be actually credited with a total amount of. We then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check when the partners charged any interest. When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that one should be added to the amount to be shared. Sasa? Yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Renette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2, after allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the loan from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what? All commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? And Renette. So, and we are told that this one will be 10%. This one will be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Renette is 18,800. 18,800. 10% of that will be 18 what? 1880. 18 what? 1880. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa, Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna, maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So in our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business. So then from there, the other appropriations the partners may be entitled to is what? Is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So you have 42,800 minus 43,70 minus 28,50 minus 18,80. So the amount to be shared as profit, I'm getting 33,700. Now that profit will be shared among our three partners, John, Kelvin, and who? And Renette. So they will share a profit of 33,700, 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3 is to 2. 5:3 is to 2. That is for John, Kelvin, and what? And Renette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Awesome? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and the net 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16, 850. Kelvin, we take 700 times 3 divided by 10. And basically that will give us 10, 110. And then the other partner net, that is 700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0, because that amount of profit has been shared among who? Has been shared among partners. Now, once you're through with that, then we can proceed and basically cross off the books of account of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. Realization account. So what we just need to remember here is what do we record in this particular account, the realization account. What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners. The partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is a ledger account. Is a ledger account. Partners current account is basically a ledger account. Ledger account means that this account will be having a debit and the credit side. The debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here. And then column for the 3 partners. We have the first partner, who is John. We have Kelvin. And we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John, we have Kelvin, we have Renette. This, remember, is the credit side. And also the figures are in what? In thousands of shillings, like that. In thousands of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to close all those accounts. You close off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information with number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was partners. Remember, you have taken over by partners, should be debited in this account, should be debited in the partners capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partners. The last item in the trial balance was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liability of the company. So we are given liabilities which were taken over by the company: property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities. All those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance, not the value which is given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa? Yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company, in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 25,240. So, and then from there, we have equity investment. Equity investment, this one, was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the
class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait I give you 2 million shillings after 10 years. Which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value? You bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, here we have present value, and future value. So present value, we have that direction and we have this direction. To say, you can work from present value terms to future value, or you can work from future value to present value. When present value, we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come and value of this amount? So you go backward. From future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. More than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000s that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, So this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20%. per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annual. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. That is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before we continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20% compounded annually. The investment will earn interest at a rate of 20% compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60 60, 60, 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000 So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we're saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R percent power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting, I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Oh, okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equals to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000? 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we are together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what we are supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equal to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equal to the annuity times 1 minus 1 plus r power negative n over R. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus R power negative N over R is called present value interest factor of an annuity R% power N. Present value interest factor of an annuity R% power N. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity R% power N. R% power N. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B, if you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay, maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, present value of annuity is equals to the annuity times 1 minus 1 plus R power n over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Therefore, present value of annuity is equals to annuity times present value interest factor annuity R% power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% to up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that we've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather have a good night. Have a good night. Check whether starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it